I'm Charlie Shields from Wells Fargo Advisors, LLC. My co-host is Richard Sichel, Philadelphia Trust. Richard, good to see you again.
Nice
How
to see
are
you,
you?
Charlie. Thanks. Good.
Good to see you. Okay, the special guest tonight, Nick Yzzi, CPA, who has his own firm, Yzzi and Associates, and with all the changes in the tax laws, and this year you're probably going to get some surprises when your accountant tells you how much you owe, so we'll help to explore that and see if there's anything you can do about it next year. Stick with it. It's going to be a good show. Okay, Richard, let's talk a little bit about, I don't want to time the show for market timers. That's not why we're here.
Right.
But I do want to discuss the fact that we had a big year the year before this. And I don't want to tell people what the date is now, but we just finished a big year. And what do you tell people that come in with a lot of new money right after you've had a big year? How do you tell them to handle that?
Yeah, well, we deal with long-term investors, so whether it was a great year, whether it was a moderate year, whether it was a down year, you should be investing. You're going to be around a long time, regardless of your age.
Right.
And as I tell people sometimes, they say, well, I'm retiring, I'm 65 and 70. I say, well, you're going to live 30 years whether you want to or not, and you need stocks. You need stocks and bonds,
anyway,
right.
Yeah.
So, you get them invested, you look for opportunities, and you don't have to jump in all in 5 minutes to do it. And
Sure.
And there are always, even in a great year, there are always reversals, and there are certain stocks, certain industries that get hit, get a little more value into them, and and then we'll pick them up and get the people fully invested over a reasonable period of time.
Yeah, I agree. Back when price-to-earnings ratios were 10 in the U.S., somebody came in with a batch of money. I was pretty confident to put it to work right away, but when the PEs are up at 14 or 15, I'm a little slower, maybe dollar cost average a little bit with the new money.
Yeah, and you can do a partial position. You like certain companies. You want a 2.5% position, you buy 1 or 1.5, and you get some opportunity. So no need to toss everything in, but also no need to say back away and I'll wait for a big correction or something like that.
Sure.
Then when the big correction, if it does come, you're going to say, well, maybe I don't want to go in now because things are a little dicey. So long term, buy good companies and give them time.
Fair enough. And I do want to remind our viewers and listeners, the two of us are not CPAs. We do have a CPA. They'll give them some advice, but we're also not tax attorneys, and we do want people to consult their own financial advisor before they make any decisions. And as far as my firm is considered, Wells Fargo, we consider this an advertisement, and I need to disclose that to people. Okay, well, let's hit the second subject, emerging markets. There's been a lot of talk lately that emerging markets are in trouble. Does that mean it's time to buy now, or how are you thinking about that?
Yeah, again, it's sort of, you take the reverse of what the big story is, and when everybody loves it, be wary of it, stay away, or get your toe in a little bit. Sure. But now it's sort of, well, the emerging markets, et cetera, have done poorly, so don't go there. They'll be fine, and again, long term, they're going to be all right. We're a little bit unique because we use individual stocks and individual bonds. We don't use funds of any kind. So, and we use U.S.-based companies. Just we understand their accounting better. We feel better about them.
So your overseas investing is because those companies do business overseas.
Yes. So you get the multinationals like a Coca-Cola. They get 75% of their revenues overseas, and so we will get the growth that way. And we're you'll miss a few of the home runs when Thailand does better than anyone else, but you'll also miss some of the disasters that come along.
So you don't use ETFs either, you just use...
Typically not.
Okay. Well, how about, let's talk about interest rates for a second. The common conventional wisdom was that interest rates would rise as the economy was going to recover, and in the first quarter of this year, interest rates have not risen. Does that mean we're in a soft patch in the economy, or are we in for some trouble during 2014? Do you think the economy is going to soften up? What do you think?
Well, rates had a quick rise at the end of last year,
right,
and went from about 2.5 on the 10-year to about 3%. And the 10-year bond is the one that mortgage rates are pegged off of, so people pay attention to that. And yes, the yield has come down now. The price has gone up. And again, because the economy gives mixed signals about are we growing, or how fast are we growing? Yes, we are, but it sure isn't on any kind of great trajectory. But there's improvement. But rates have come down some, and the Fed is very, very accommodative, even though they say they're tapering, pulling away a little bit. They're still pouring money in. And it means that basically the economy needs some of that. The economy is growing slowly, and interest rates, are relatively low, and they're higher than they were. I mean, at their low, that bond was 1.5%. So they've moved up. But again, just like with stock, you get some of that even in bonds. And it's tough on the saver. The Fed has taken very good care of anybody who wants to borrow. Unbelievable mortgage rates are just about a gift.
I imagine
but if you're a saver, you're out of luck.
I imagine you're being cautious, staying kind of close in on the terms of the 7 years or less type of thing.
Yeah, we try to have maybe a 3 to 4 year average maturity in the bonds, and you don't want to reach on quality and go down low quality to get yield, and you sure don't want to go out 20 or 30 years because at some point rates will move up. At some point there will be inflation, and the best stock is going to do that as it goes up. You don't want your bonds doing that, so you want to keep it as safe as you can, and say the shorter maturity, the better. And then when rates do go up, your money is there, and then you can buy, go out the yield curve and buy some higher coupons.
Okay. And looking at sort of the allocation of stocks, the small and mid caps had a really good year in 2013. Are you de-emphasizing those right now, or do you just feel like you have the same constant percentage and you're going to pick some stocks from those sectors now also?
Yeah, good question. Our style is large cap and mid cap. We really don't get involved in the smaller companies. They're more volatile, and there are years that they do better, years that they get hit. And their earnings are less predictable. They typically don't have dividends, so we'd rather try to find some predictable earnings if that's possible, and some good dividends and good dividend growth. And we think the mix of large and mid cap will serve people well. There will always be periods of time where one does better than the other, but if you have a mix, again, you don't have to be a hero every day. You want to sort of be a long-term hero.
All right, good enough. Okay, well let's talk about that search for yield. I know that you said you stick with the 3 or 4 year maturities, that type of thing. Are you going overseas at all to look for any income, or how do you, or do you use cash when you're afraid that interest rates are going to rise to wait for rates to rise to jump on further out maturities? How do you do that?
Cash has been deadly, obviously. Cash is close to zero yield, so you really don't want to have that. You can buy some maybe very short-term bonds to get something. And then, there was a run to dividend-paying stocks a year ago, and I'm surprised it didn't happen sooner. There were very good companies paying 4, 5, 6% yields. Yeah. And these companies like a Verizon or Kraft, they can well afford to pay the dividend. They can afford to increase it, which they do pretty much every year, 5, 10%, which is getting a raise. And they're very secure. And investors just have to watch it. They don't say, okay, well, I'll buy all those.
Yeah.
You can have one bad day in Kraft, the cream of the crop, and it'll offset your dividend right at that point. So again, it's long term, and again, you don't want to rush in and say, this is perfect, this is perfect, this is perfect, this is good, let's do this, let's try this, let's try this. And we do recommend, some kind of a portfolio of the higher dividend-paying stocks, along with, moderate term treasuries, agencies, and if you can, get a good corporate bond. And
all right, great.
We'll at least be doing a lot better than money market rates, and with a fair amount of safety.
All right, good. We have a question from one of our viewers. Nancy Richards of Exton says, what are some saving strategies tax saving strategies for investing? In other words, she wants to worry about her taxes while she's trying to make money. How does she do that?
Well, various ways. We'll have our tax expert over here. He can correct me on these things.
All right.
But yeah, if you have IRAs, it's wonderful. They get to grow tax deferred. That's very nice. You contribute all you can to your 401k, and if there's a match, that's wonderful too. And again, you get, you're not paying taxes at that point, so you get the growth free of tax. And again, dividend-paying stocks, and you can buy tax-free municipal bonds. They're always a little more difficult to find good ones and ones that are not due in 15 or 20 years, but there is value there too. So, you just sort of want to maximize where you can the tax savings accounts, types, like IRAs and such.
Yeah.
And then, have a mix of dividends and some income, and not very much in the money market, which is, again, gives you no yield at this point.
Yeah, I agree. I have tried to get my clients to do their rebalancing. If the market goes way up and we're overweight stocks, I try to get them to rebalance in the tax-deferred accounts, so we aren't creating a lot of capital gains unnecessarily. Now, obviously, if you have some stock like Google that goes up 4 or 5 times and it's in your taxable account, it is a 15% capital gains rate for some people, and I guess as much, we'll find out later, as much as 25% or so for other people. But if some stock's about to correct, you can't let the taxes determine whether you're going to sell.
I always tell people, sometimes you spite yourselves, well, don't take the gain, I don't want to pay the tax. And you know, as you know from years ago, tax rates were 50 or 70% way back. The capital gains rate, if you're going to pay a tax, it's much more enjoyable to pay that tax than, wow, here's my income for the week, and whoa, this is what's left. Here you got smart, you got lucky, you take the gain, pay some tax at a lower rate typically than your income tax, and enjoy the gain.
Terrific. Okay, if you have any questions, please send them in to Money Matters, 205 East Levering Mill Road, Bala Cynwyd, Pennsylvania, 19004. Or if you're proficient on the internet, send it in to moneymatterstv@gmail.com, and we'll try to get you a good discussion and give you some things to think about to answer your question. All right, let's get to the important, and to some people not as interesting as other subjects, but it's something that's important for all of us to think about. Nick, I appreciate you being here tonight. And first of all, I know there's been a lot of changes in the tax rate. There's a 3.4% extra tax here and a 0.9% tax there. Can you talk about some of these new tax changes?
Sure, Charlie. Thanks for having me on the program. As you know, January 3rd or January 2nd of 2013, the 2012 American Tax Relief Act was enacted. And basically that became a new act. It was effective for 2013 and beyond. And what it did is it targeted a lot of high earners. And when you look at their tax picture today, it's going to be quite different when they file their 2013 return. Because what happened was for most Americans, the tax rates didn't change. But for those who are in the 35% bracket, their top bracket goes to 39.6%. In addition, their capital gains rate went from 15% to 20%. In addition to that, something connected with the Affordable Care Act, or what we call Obamacare, instituted an additional 3.8 net investment tax. So if you have people with a lot of savings, not only are they going to have increases of the 4% on the tax rates and 5% on the capital gains rates, but this additional 3.8% tax on their net investment, and that's a little bit complicated to explain, but basically it's all their dividends, interest, capital gains, annuities that would be considered passive income. You have to look at that net tax and compare that to their modified adjusted gross income less a threshold of $250,000 for a married person. And the lower of that is subject to a 3.8% tax.
So you mentioned that that's in annuities also. Does that mean they're going into IRAs and that sort of thing, looking for gains you took there?
Yes.
Okay.
And there's some ways that you could try to plan around the reduction of that additional 3.8% tax. So I mean, some of it could be you have a big capital gain this year. You could offset it with some loser securities that you want to get rid of. I mean, that would be a good idea.
But losers are getting scarcer, which I guess is a good thing. But
that is a good thing.
That's a good problem.
Sure.
Yeah.
But there's always something you can do in the planning side, but you can't take it for granted now because you really do have to look into the planning, maybe invest in growth stocks where you're not going to have those capital gains necessarily like you would.
I want to make sure I'm clear now. I always thought that within an IRA, the only time you created taxes when you took money out.
Correct. When you take it out.
Okay, so,
absolutely.
Okay, so if you take a gain in your IRA to rebalance or something,
they
don't
absolutely
go in and get the 3.5.
No, it would have to be on withdrawal only.
Okay.
And then you mentioned the 0.9% tax. That's another Obamacare connected tax. And that basically, they call it the Medicare tax. And that's going to be an additional 0.9% tax for those who fall in the $200,000 to $250,000 range. So $200,000 for a single person, $250,000 for a married person, and that gets added to the 1.45% they already have withheld. So when you add all those things up, Charlie, you're talking about a potential maybe 14–15% additional tax on people who are approaching the $250,000 range. And in the case of the income taxes and capital gains, the $400,000 adjusted gross income range. So it's quite significant. And I could say that people are not overly happy about this because they seem to be targeted. When you look at the statistics of who pays the most taxes in this country, you could pick on that group, but that group pays the bulk of the taxes in the United States when you look at the IRS statistics.
Sure.
And you don't know how much you can go after one group because half the country doesn't pay any income taxes. So it's a concern across the board for those who are earning dollars at the point in time in their life when they feel that they've already paid a tax burden. Some of the good things when you talk about people who have invested and get to their later golden years is that the Tax Act of last year has also permanentized at least the estate taxes. So that was subject to a lot of maneuvering and ups and downs in the sunset provision. What it did do is it established a $5.25 million exclusion if you died in 2013, and it's going to be $5.34 million if you die in 2014 with a 40% maximum rate. So
Does it index up a little bit every year?
it is going to be indexed every year too, so that's good. So it's a lot better than what we had because it was intended to be reinstated back to the old $1 million.
Right.
And a lot of these changes that have occurred this year really go back to the reinstatement of some of the rates that went back to 2001 when the first Bush era tax changes, the first major one was enacted.
And they'll be phasing out some itemized deductions for people up in the high rate.
And that also, good question, Charlie. That also adds to the net effective tax rate. There's something called the PEACE limitation, P-E-A-C-E, that hadn't been around since 2009 because it had been suspended. But basically, for a person who's in the high income bracket, again, $250,000 to $300,000 range, that can eliminate up to 80% of their itemized deductions, which could be significant if you have a large home, let's say, or a large debt. And then there's also limitations on the personal exemptions, and you can lose all your personal exemptions if you're also a high income earner. So when you factor those in, you could be adding another 5% to your tax burden. So you add all those elements up, and you may be between 15 and 20% additional taxes.
And you don't hear those numbers when the politicians talk about it, 32 point whatever, but
that's right.
They don't
You
mention
don't
those,
hear them, and the average
that's very
person,
real.
Sure. And the average person doesn't realize it because their rates have not been affected for the most part. It's really aimed at the high earners. So how long can you go after these high earners and expect them to carry the majority of the tax burden in this country?
Yeah, many of our viewers and listeners are hardworking couples that make $180,000 or $120,000. Just talk for a minute about what effects the new tax laws will have on them, if any.
Well, again, they could be involved with some of the taxes we just talked about.
Yeah.
But I think for people,
gains.
the people in that range, I think, are the ones who get hit most by what we call the alternative minimum tax.
Okay.
And the alternative minimum tax is basically a second taxing system that has a different set of ordering rules where things that are deductible for regular income taxes are not deductible for alternative minimum taxes. When you compare them side by side, you end up having to pay the larger of the two taxes. And what's happened, it was enacted about 1969. It was intended for those who had tax shelter deductions, which are no longer allowable for the most part, and they weren't paying any income tax. So it was meant for very high earners who were involved in oil and gas shelters and such, and types of real estate. And it was meant for them to pay at least a minimum tax. Well, what's happened, it evolved over a number of years. They didn't index the exemption, which is one of the biggest problems. They do now as of this new tax law, but they didn't index the exemption for so long a period that it threw a lot of people in that range of $100,000 to $180,000 who are now paying alternative minimum tax when in the past they wouldn't be subject to it. They'd have a lower overall regular tax burden. So what you have here is you have people up to about $250,000 who'll be subject to this second taxing system, which oftentimes is a surprise. And it requires, again, tax planning to make sure that you get you maximize the exclusion that's available. For instance, for a married person, it's $80,000. Once you get above $250,000, you lose that exclusion. So there's ways, again, of trying to minimize your tax burden from year to year by, let's say, maximizing your 401k or 403b, by, again, taking losses if you can find them in your portfolio to offset capital gains so that you're not going to have a large income and an adjusted gross income number.
So if you're a W-2 employee, if your firm allows you to take deductions for expenses, you should do that, right? Because that wouldn't show up.
Well, it does. That's interesting, Charlie. What happens is, let's say you're making $200,000 a year as a W-2 wage earner, and they don't reimburse your expenses. You have to deduct your expenses, your car and travel,
Okay.
and you have $25,000 of expenses. Those expenses are considered miscellaneous deductions that flow through from Form 2106 through Schedule A to your 1040. What happens is that $25,000 of unreimbursed expenses become a tax preference where they get added back to your income for purposes of calculating alternative minimum tax.
I see.
So in that case, you could end up paying tax where you wouldn't ordinarily if you were a sole proprietor, let's say, in your own business. And that's an opportunity where you can make an arrangement with your employer to say, put me on an accountable plan or reduce my salary and give me credit for the $25,000 that I have to put out, just reduce the salary so it doesn't create this tax benefit, and you can save some significant dollars sometimes by not having that tax preference item for those unreimbursed business expenses. So they
Those
actually
things
have a
take-
negative impact.
Yeah, they take people by surprise.
They do,
Where did this come from?
because
So-
the alternative minimum tax rate is 28%.
Right.
Now, if you're in a very high bracket, like the 39.6%,
Yeah.
it won't matter anyway because you've gone through all those increases anyway. Your tax burden has been maximized. AMT or alternative minimum tax won't really impact you. But for those to go up to about the $250,000 range, there's a lot of things you can do. Maybe bunch up deductions, maximize your retirement plan contributions, maybe stagger your investment. Maybe you can go to your investment broker and say, look, instead of, can you take these investment expenses and factor it into my rate of return so it's not an itemized deduction on my taxes? And that may also have the benefit of reducing or eliminating your alternative minimum tax.
There's another thing they've been doing 1 year at a time, which is you're allowed, over 70 and a half, you're allowed to deduct, take your RMD, your required minimum distribution, and donate it to a charity and thereby avoid the RMD tax. Am I wrong about that? Okay.
That's an IRA transfer to charity, but unfortunately, they reinstated it last year. They did it retroactively for 2012. They gave you up till February, the end of February, to do a 2012 deduction in 2013.
Yeah.
But unfortunately, that has expired as of 12/31/13. It was in the works to be reinstated, but because of what's going on in Washington, it is not yet back on the books. I would venture to say that it probably will be before the end of the year. But that is a tremendous savings because the only way to get rid of, you can't get rid of a deduction into an IRA.
And it sounds like a win-win. You know,
Yeah.
the charities get more money.
IRAs are always taxable.
Yeah.
That's the only way where it is not taxable, when you can transfer $100,000 a year
Right.
per person
Yeah.
directly to a charity.
Well, that was something good.
But right now it's gone, but I think
It might
it'll
come back?
Yeah. It has come back retroactively almost every year since it
Right.
was enacted about 7 years ago.
Just love that planning that Washington gives us.
Yeah, it's difficult.
It's
It really is.
Always looking back and
Sure.
Yeah.
fighting and
Yeah.
Let's
retroactive.
explore same-sex marriages for this tax ramifications.
That's a
of
new
it.
development as of 2013, and again, the Defense of Marriage Act went to the Supreme Court, and certain parts of it were declared constitutional, certain parts unconstitutional. After that Supreme Court decision, the IRS decided that they would allow a same-sex couple to file a joint tax return if they are married in any state in the United States, even if it's not the state of their residence. So you could be a Pennsylvania resident who does not recognize same-sex marriage, go to New York and get married, and then you'd be able to file a joint tax return. If you're still living under a civil union or a domestic partnership, you are not permitted to file a joint return. You really have to go to a state that allows same-sex marriages.
So then there could be a difference in the way your taxes are computed in Pennsylvania for the state tax versus the federal.
Yes,
because-
absolutely.
So it sounds like another reason to hire a good, smart CPA
Not
like
another, it's another nightmare.
More
And,
reasons every year.
Yeah, and it's interesting. There have been articles about, do you do your tax return on your own, or do you consult with a CPA? And it's become really difficult. It's easier for people to do it with these software programs or online, but you really have to be careful because you're not going to take into consideration the planning possibilities.
Right.
Well, I looked at the AMT instructions the other day for one of my clients. It seemed like it was like 40 pages or whatever, just
Sure.
a whole separate. So that's another reason people
It's
should be
horrible,
very
yeah.
careful. A lot of people are just going to go on TurboTax or whatever and compute. And I don't know if those outfits throw in how to do the AMT also to compare it with
They
the
do,
other,
but if you don't put information on the right line, it'll come up with the wrong answer.
garbage in, garbage out.
Sure,
Yeah.
absolutely.
All right. Well, suppose I came walking into you today and said, I need some help for 2014. I want to start planning now. talk to me about what kind of records I need to keep so that I'm going to keep myself out of trouble. And
Well, as far as record keeping, I mean, I tell people don't throw anything away. But more importantly, if you're going to come in and start with a new client, you want to look over everything from A to Z. I mean, their portfolio, get in contact with their investor, look at their retirement plans. Are they allowed to match what their employer might match?
Right.
It'd be foolish not to make sure you maximize the match.
It's a gift. Right.
What are they invested in as far as the taxes are concerned? How can they reduce or eliminate alternative minimum tax or this net investment tax? What are they doing for the children? Could they be involved in educational provisions that would save money down the road where they can go into a 529 plan possibly?
that's an interesting subject. Can you talk a little bit about the advantage of if a grandparent wants to put some money aside for college for a youngster?
Sure, that's one of the best ways to provide for your grandchildren would be to get a Coverdell educational savings account, which is more limited. You can only put a couple $1,000s a year away, but in a 529 plan, you can put unlimited dollar amounts into an account for the benefit of the beneficiary like a grandchild. And as long as that money is used for college, all the earnings build up over the years, similar to a Roth IRA, would never be taxable.
Is there gift tax if you give too much?
No. So it's a tremendous tax planning opportunity as far as deferral of income.
Right.
But it also it doesn't get you a tax deduction, but it gets you that like a Roth IRA, that earnings build up over time, and it also enables money to be passed out of their estate, because it's not going to be taxable then to the grandparents'
And
estate.
I understand if there's a sibling, like if it's set aside for one youngster, and then that youngster gets a scholarship to college, whatever, it could be used for
You
a
could transfer
sister
it to
or a
another
brother.
sibling. That's right.
And as long as it's used for the purposes it's designed for education, there's no tax. Now, if they don't use it for some education, if it turns out the youngster isn't going to school or whatever, and they take the money out, then there's
There
a
would be
tax
tax.
event.
Yes,
right?
there would be.
Okay. Well, we've probably got about a minute left here. Is there anything else you want to leave our viewers and listeners with? Any thoughts?
For Pennsylvania, not a significant change, but one, if you're a tax preparer, if a spouse dies during the year, you could not file a joint return for the state of Pennsylvania, which was a nuisance because you had to prepare two separate returns, and I'm not sure why they ever did it that way. So now when a spouse dies in a tax year, you could file a joint return like you would with the federal government for that year of death, and it just it doesn't become a compliance nightmare. But that's about the only significant change for Pennsylvania. Everything else is the same,
Well,
same
Nick,
tax rates.
Nick, Yzzi, we appreciate you coming in at a
Thank you.
time that people are starting to think about the pain they're going to have to go through, and for people who are making quite a bit of money, I think it's really worth considering using an expert like you. I think you've convinced us all tonight that it's too complex for somebody just to sit down on a weekend and put their tax plan together. We hope you'll join us next week. As far as I'm concerned, these are really informative shows, and I hope you feel the same way. We're going to have David Son of ARC Intermedia as our guest next week, and it'll be another informative show. We hope you'll join us every time. As far as we're concerned, your money matters.